Hey everybody, this is Jim at SP500chart.com. It's Saturday night on December 28th, 2013. Going to be doing some visiting with family tomorrow, so I'm doing this on a Saturday evening. Let me just read this to you real quick. The website and the video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. And I am not a licensed financial professional, just a guy that draws lines on charts. So let's take a look at what happened in our last week, which was shortened by the Christmas Eve half day and then Christmas being a market holiday. So we got 3.5 days to look at. Let's do it. Starting out here on a 30-minute chart, let me squeeze this in just a little bit more right here to remind you that the overall picture we've been looking at over the past week or so has been that of what was originally considered a potential inverted head and shoulders, and again, one of those that has almost no right shoulder. And I don't like that. It makes it kind of a hard thing to commit to, but we've seen it. I think this is probably either number 3 or number 4 in the S&P, where we've seen what looks to be a perfectly normal continuation pattern develop as an inverted head and shoulders pattern, and then we end up with almost nothing of a right shoulder. This particular pattern has a target of about 1848. Okay, and to help us keep that in mind, let's just put a horizontal line here, and we'll make that kind of a bright green since there's nothing else on the chart. There, we'll make it, instead of a bright green, we'll make it that little light color. So, not quite there. Close, but not quite. So, what happened during the week? Well, to be honest with you, this week was, because it was a shortened week, and we were over this neckline. We started the week on the 23rd, and basically, we just kind of melted up and stayed underneath a trend line that we later, we did not recognize this line until we had our trading on the 26th. Because prior to then, all we could spot on this chart was another resistance line right here. But when we saw the way this traded on Thursday, staying right under that line with 1, 2, 3, 4, 5, 6 touches. Well, no, 5 touches on Thursday. That kind of clues you in that something's going on in that little very narrow range of trading on Thursday. Now on Friday, oh, by the way, on Thursday I said this looks like this could be a wedge shape here, so let's watch it closely with the idea that if we fall out of that wedge, we may come back and test these levels down here in the low 18, in the middle 18 teens, or maybe as low as 1810 or so. So as a week, it's only 3.5 days. We were, because we were over that neckline in our rather strange-looking inverted head and shoulders pattern, all we could really say with any degree of, what's the word I'm looking for, confidence, is that we should stay above this level as support, which we did for the entire 3.5 days. I'm going to throw a little monkey wrench at you now. When we broke this line, it did not break in what would be a typical kind of your tumultuous breaking. Usually wedges, when they break and they're rising wedges, typically the break is fairly swift. Now when it's a descending wedge, a lot of times you break above that top resistance line, and often a descending wedge, it'll just wander. You'll wonder, is this what I think it is? Even after it breaks out, it can just kind of be lazy and just taking a very meandering path, but eventually it usually firms up and then starts to behave. The break of an ascending wedge tends to be a bit more typical of a sell-off, and it usually happens fairly quickly. But here's the monkey wrench. As we thought we were in an ascending channel, and maybe you didn't, I did. As I thought we were in possibly a narrow ascending channel after getting above our neckline, and that channel would be between these two light blue lines, I'm going to throw something out at you. Maybe we're in a channel and these are our two lines. So I'm gonna temper what I mentioned after the close on Thursday, and that would be breaking this line should set up that move down to test our neckline, or maybe down into the low 18 teens. But I'm going to temper that now, because this could be a significant. Well, let me backtrack from that just a little bit. This line could be technically significant. I don't want to say it could be a significant line, because we've got other lines in the chart that really rise to that description, and this is probably not one of them in the terms of being strongly significant. But the fact is, we've got a pretty clear resistance line here. This line is perfectly parallel to it, and it just could be that's what we're looking at here. All of this action would have taken place after getting above the neckline, and we've seen that before. So I'm just going to temper that a little bit with the idea that if this line breaks, then I would say that would be a more likely a sign that indeed we are going to head down for a 25 to 30 point trip down. Interesting where this happens here at the end of the year. Most people maybe, I would think, possibly anticipating a January effect where anyone who might sell, I mean, who sells for tax loss after a year like this? But just the same, maybe, So, or it could be that some people want to take gains. Maybe they took losses and been carrying them forward for a number of years, and they're saying, I got profits. I'm going to get out of this right now. See what happens at the beginning of 2014. Let's take some profits and pair those up with capital losses from prior years. Maybe that's, you know what I'm saying. There's a number of reasons, but it will be interesting going forward, because we've got a grand total of two days before we're into 2014. So this will be very interesting. So what I want to do, I'm going to make this pretty simple. Let's go, instead of with this line as a fairly important support line, even though it still could be, I'm just going to change that a little bit, and it's not a very costly change, because this line broke, though not by a technically significant margin. That line broke at 1842.5. This line, if it breaks, it will be at 1841. So it's a very easy thing to extend this out here and give the S&P a little bit of the benefit of the doubt, maybe, to see if it wants to bounce off this line and then get on up there and make our target minimum in earnest. So guys, there's your video for the week ending December 27th, 2013. Pretty basic thing throughout the week. We started out above our breakout line, this inverted head and shoulders, or shall I call it shoulder and head pattern. Broke out. We've been going up ever since. A little weakness on Friday, but not a tremendous amount. And that leads me to believe we may bounce on this line. Now, since this is a weekly wrap-up and a weekly review, I want to remind you, if you are a subscriber, keep your subscription active, because if you let it lapse and then you sign up again on January 1st, after January 1st, it's going to cost a little bit more. Additionally, if you are not a subscriber and you've been thinking about it, you've been sitting on the fence, now's the time to do it. If essentially, when I go to the new price structure on January 1, if you sign up before 2014, you will end up with the same thing as getting 3 months for free. Okay, does that make sense? Because it's going up 25%. With it going up 25%, that means you would be spending less money in 2013, and you know what I'm saying. So anyway, if you've been thinking about it, sitting on the fence, now's the time to do it. It's only $19.95 a month. That's cheap. If you buy $4 premium coffee at Starbucks every day, just for 2 weeks, instead of buying premium, buy a regular cup of coffee. That will pay for it. So look, guys, thanks for watching. Take care. And look for videos after the close on Monday and Tuesday.